If you think a high credit score is the only reason for instant approvals, then you might be missing a crucial piece of the puzzle. In this video, I'm going to review why focus on solely on your credit score can leave you disappointed. As someone who has been in the credit game for over 15 years, an 800 plus credit score, and has helped plenty of others rebuild their own credit, I'm going to help you build a credit profile that lenders are going to love. If you stick around to the very end, I'm also going to give you a free checklist so you know exactly what you need to build the perfect credit profile. So first, let's go over the key differences between a credit score and credit profiles. So with credit scores, think of it as like a quick credit snapshot. It's a 3-digit number that's calculated by the credit bureaus, which can range anywhere between 300 to 850, and it is based on 5 key factors that include your payment history, debts, new credit, credit mix, and length of credit. While credit scores only briefly show you how well you've been doing with your credit profile is what matters the most. This includes all the types of credit that you have, whether it be credit cards, mortgages, student loans, all the credit that you applied for in the past 2 years, your credit limits, loan limits, pretty much all the fine details in the past 7 to 10 years. So another way I can put it is by referring to video games. If you ever played a game where there's ratings for a player, it usually lists out all their details such as their speed, agility, strength, and other factors that comprises of an overall score. So those ratings will be comparable to what goes into a credit score, and your overall score will be a quick snapshot of your credit rating. Your score is just an overall picture of what your score is like. A player in a game may have a decent score, but they may be kind of slow or they may not be that strong. So when it comes to your credit, this is very similar. You may have a good payment history and low credit utilization, but you might be fairly new to credit or really haven't had that many accounts. So the more well balanced your credit is, the higher your score would be, but also the underwriters will like to see what are your strengths that you have when it comes to your credit. Because lenders just don't want to see a number, they want to have a full picture of who you are as a person so they can make sure that they get their money back. So now let's talk about building a strong credit profile. So I was actually able to find a FICO presentation that breaks down exactly what goes into your FICO score and what needs to happen to give you the strongest credit profile. So let's go over this presentation so you know exactly what goes into your FICO score directly from the source. First, let's break down your payment history. The key factors are how recent they are, how severe they are, whether it be 30 or 90 days late, and how many credit obligations have been delinquent. So essentially is how many accounts have you been late on. Now, taking a look at this chart of your risk compared to your most recent delinquency, as you can see, late payments within the first year are gonna do damage to your credit score. After the first, going on to the second, your risk gets pretty much cut in half. Then it slowly just trickles down until there's no delinquency. So even though you can see with the last bar with no delinquency, it still shows that you are at low risk because you really never know if anyone is ever going to be late or when it happens. Now let's go over your outstanding debt. Sometimes this is called amounts owed. Some people just refer this to credit utilization, but overall, this is the amount of money that you owe to lenders. So let's talk about the determining factors in this category. It's pretty much how much money is owed, what percentage of the available credit that you are using, and what percentage that are still outstanding on open installment loans. This is actually one factor that most people forget to mention because loans affect your credit limit a little bit differently and they have their own utilization criteria. So let's just say that you have a $10,000 auto loan and you still owe $9,000. That loan roughly has around a 90% utilization. And with loans, they have the most positive impact when they're almost paid off. Now, let's take a look at this chart that talks about revolving accounts. This could be your credit cards, HELOCs, lines of credit, pretty much anything where the balance can fluctuate. Ideally, you want to keep your balances below 19%. This will make it seem like you have the lowest risks. But for me, I generally recommend under 10%, but a general rule of thumb that you can find everywhere is usually around 30% and under. So as you can see right here, between 20 and 39% is the second lowest bar. As your balance gets higher and higher, the riskier you become. That's why reducing credit card debt quickly is the only surefire way to instantly boost your credit score overnight. Now let's move on to break down your length of credit history. So the key factor that goes into this is how long the accounts have been established. Basically, the average number of months accounts have been opened and new accounts, which is the number of months since the most recent account has been opened. Now let's take a look at this chart. This means that the newer you are to credit, the riskier you'll be, which makes sense, right? That's why I recommend keeping your cards open as long as possible. So if you're thinking about canceling a card that has an annual fee, consider downgrading it first so you can keep that credit history. That's why credit is a long game and you gotta keep playing it. Now, this is why I would like to mention my private community, the Credit Collective, where I don't talk just about credit, I'll talk about how you can leverage it. So whether you're repairing, rebuilding, or trying to learn ways to get up to $250,000 in business funding, you're gonna learn it in this group. You'll get access to all my online courses, a community of like-minded individuals who are in the same shoes as you, monthly Q&A sessions, and I'm gonna have special guests on there as well. On top of that, we're gonna do monthly giveaways, and you get access to all of my resources. The information in this group is what other gurus charge thousands for. So if you'd like to learn more about how to join the Credit Collective, let's build, repair, and leverage credit together. Link in the description. Now let's talk about the pursuit of new credit. This usually comes down to inquiries, which has the most impact within the past 12 months, and the new accounts, which is essentially the number of trade lines that were opened within the last year. So as you can see, the criteria for new credit is basically just what happened within the past year. Now let's take a look at this chart. If you have 4 or more inquiries, you're going to be considered high risk whether you have a young or mature credit profile. If you have a more mature file, which means that you have multiple different types of accounts and have credit cards that's been open for 5 years plus, and you have 2 to 3 inquiries, this is going to give you moderate risks, but really not a deal breaker when you are seeking for new lending. This is why I recommend applying for credit cards every 6 months or so you have less of fresh inquiries that are showing upon your credit report. So on that note, I know a lot of people have questions about shopping around for rates, especially when it comes to mortgages and car loans. So this chart right here essentially answers that question. Now, whenever you shop for rates, anything that happens within a 45-day window, this would count just as one inquiry. That's why you can actually shop around and shotgun your credit if you wanted to, and at the same time, all of those inquiries will just count as one on your credit report. So now let's move on to your credit mix. The key factors in this chart is essentially the mix of credit products that you have. This includes revolving lines of credit and installment lines of credit. Here's an example of a partial FICO scoring model, which gives us a better picture of what affects what and what can help you get the highest possible credit score. So on this chart, whenever there's a high number, that will have the most positive impact to your credit score. When it comes to your payment history, if you have no delinquency, this will give you the maximum amount of points. The good thing is that anything that's older than 2 years, you will start to see a better improvement on your credit score. When it comes to outstanding debt, actually having anywhere between 1 to 6% utilization will give you the highest amount of points. And the second runner-up is having 0 utilization. That's why I honestly think anything under 10% is an easy number to remember, and it will give you the maximum benefit. Now let's talk about credit history. So this is the number of months in the file, essentially your longest trade line. So if you had trade lines that are over 4 years, that's the magic number to get you the maximum amount of points. When it comes to pursuit of new credit, the characteristic that really matters is the inquiries that happened within the past 6 months. So if you have 0 inquiries, you have the maximum points in that section, and anything more than 3 will give you the lowest amount. Now when it comes to your credit mix, this one only shows the number of bank card trade lines, which are your credit cards. So to get the maximum amount of points in this section, you need to have exactly 3 credit cards. As you get more and more, this would affect your credit score. So for me, I have 30 plus credit cards, so I'm willing to take that hit so I could utilize more credit. So with all the information that we know right now, let's sum it up real quick so you can get the ideal credit profile. You should have no late payments, keep your utilization low on your credit cards, preferably 6% or under, have at least 4 or more years of credit age, have no inquiries within the past 6 months, and have between 2 to 3 credit cards. Even though this is just a sample, I would also recommend having different types of installment accounts on your profile as well. This means having loans like auto loans and a mortgage. Out of thousands of credit reports that I reviewed, I generally see people who have 800 plus credit scores typically have a mortgage trade line on their credit report. Now, I'm not telling you guys just to get loans just for the sake of credit. If you can pay off your debt and your loans, then pay it off. Credit really only matters when you actually need it. And if you don't, then more power to you. When it comes down to the amount of loans that you can get, it really comes down to your industry scores. FICO has different credit scores for different things, such as one for your auto loans and one for your mortgages, and one actually for credit cards only. So, for example, let's just say that your highest auto loan that you ever had was $30,000. It's gonna be very unlikely that you get approved for an auto loan for $100,000. Even if you had a high income, your chances are still slim. I have known people who make 6 figures and still could not get approved for a $60,000 auto loan. It is because underwriters really don't know whether or not you can handle that amount of debt. Now, once you get an auto loan, you can usually get anywhere between 50 to 100% more the next time. So for instance, if I had a 50K auto loan before, for my next auto loan, I could probably get closer to 75 to 100K for my next vehicle. and the cycle will just continue until the bank or credit union can only offer so much. This also pertains to credit limits as well. If lenders saw that you had higher credit limits in the past, you have better chances of getting approved for higher limits in the future since they see that you know how to handle this amount of credit. So down below is a checklist that you can save that will be your guide to help you build the perfect credit profile. If you want to learn more about how to construct your credit for cars or mortgages, check out these videos over here.